Good day, everyone. For today, we will discuss the accounting cycle, particularly the first three steps. Okay, these are identification of accounting events, analyzing the identified accounting transactions, and recording transactions in the journal. By the way, my name is Catherine Elguilla. I am a certified public accountant and also an accredited accounting teacher. Before we proceed to the first three steps in the accounting cycle, let us define what is the accounting cycle and what are the steps involved in the accounting cycle. Okay, the accounting cycle is a series of chronological steps or procedures performed to accomplish the accounting process. So you have to follow these steps before you can complete the accounting cycle. So we have here, number one, identification of accounting events. Number two, analyzing the identified accounting transactions. Number three, recording the transactions in the journal. These three, that's our topic for this session. Although in the previous discussion, we already discussed, okay, in the previous video lectures, we already discussed step number one and step number two. Okay, so in our discussion this session, we will focus more on the recording of transactions in the journal. And then we have step number four, journal entries are posted to the ledger. Number five, preparation of a trial balance. Number six, preparation of worksheet. Number seven, preparation of financial statements. Number eight, adjusting journal entries or journalized and posted. Number nine, closing entries or journalized and posted. Number 10, preparation of the post-closing trial balance. And number 11, reversing journal entries are journalized and posted. So just imagine the number of steps that you have to do and perform before you can complete this accounting cycle. And at this point, we are now on steps 1, 2, 3. So we still have how many steps left? So we have 4, 5, 6, 7, 8, 9, 10, 11. So that's 8 more steps, okay, to discuss in our next video lecture. Okay, let's proceed to step number 1, which is identification of accounting events. Okay, this is the process in which we segregate the business activities into economic and non-economic activities. Okay, when you read transactions given to you, you have to identify whether those transactions are economic and non-economic activities, or whether those transactions are to be recorded in the journal or not. Okay, what are those economic activities? Economic activities are those activities affecting any of the accounting elements of values. Remember our accounting equations. If your transactions will affect your assets, your liabilities, and owner's equity, then you have to record that. And we consider that accounting events, economic activities. These activities are considered for accounting purposes. How about non-economic activities? Those activities are ignored. We do not record those transactions. Okay, related to step number 1, identification of accounting events, are the different source documents that we have to base our transactions, because in accounting we cannot just record transactions. It should be supported by proper documentations or proper source documents. And what are those documents that you have to look for in recording transactions? Okay, number 1, we have here official receipt. Official receipt is a written acknowledgement of something received, usually cash or checks. So let's say your customer or clients paid you for services rendered. Okay, so that transaction should be evidenced by official receipt, or your customer paid their account. Okay, so you have to issue official receipt. And per Bureau of Internal Revenue, businesses or entities which are engaged in services are the ones who should issue official receipt. Okay, and then how about check? This is a bill of exchange drawn on a bank payable on demand, signed by the maker or drawer, containing an unconditional order to pay a sum certain in money to the order of the payee. Usually, this check is the mode of payment, okay, of entity in paying suppliers or creditors, okay, check. How about check voucher? This is a document which serves as an evidence of a check disbursement. So meaning the check that we have in the previous slide should be supported by a check voucher. Okay? How about promissory note? This is a promise in writing to pay a specified sum of money at a specified date or on demand to certain party or to his order or bearer. So for example, your business will purchase assets, computers, or any equipment from supplier, and you agreed that the payment should be, okay, through promissory note, initially through promissory note. So in recorded transaction, if the transaction is evidenced by a promissory note, and if you are the one paying the supplier, then you have this notes payable. Okay, so you have to record notes payable in your books. However, if you are the one who received promissory note from your customer, so you book that or you record that as part of your notes receivable. So the transactions, again, are evidenced by a promissory note. It's either notes payable or notes receivable. Okay, it depends. If you are the issuer of promissory note, then in the books you have to record notes payable. However, if you are the receiver of promissory note, then you record notes receivable in your books. Okay? Next is validated bank deposit slip. So what is a bank deposit slip? This is a document which serves as an evidence that money was deposited to a bank for safety or convenience to be withdrawn at the will of the depositor or under the rules and regulations of the bank. So let's say you have cash on hand and your business will deposit, let's say 100,000 to the bank. Okay, that deposit should be evidenced by a validated bank deposit slip. Because if that is only a bank deposit slip, there is no assurance that the teller received the cash. Okay, but if it's validated, then there is an assurance that the bank, through its teller, received the cash from, okay, from any representative of your business. Okay. Next is cash voucher. What is a cash voucher? This is a document which serves as an evidence of disbursements from cash on hand. Okay, so if we have the check voucher earlier, we have a cash voucher for disbursements through cash on hand. Okay, cash on hand could be composed of your bills and coins. Okay. Next, we have invoice or sales invoice. This is a written itemized statement of items sold to the buyer together with the prices and charges on the items. And usually, the sales invoice, according to the Bureau of Internal Revenue, should be issued by a business engaged in selling goods. Okay? In selling goods. Okay? That is sales invoice. So let's say the company or the business will purchase goods or items from another entity, okay, that transaction should be evidenced by an invoice or a sales invoice. Okay, how about this one, debit memorandum? So debit, it means a written notice informing the client or customers of an increase to his account due to returns or allowances. Okay, so that is debit memorandum. So any increase to the client's account, okay, should be covered by debit memorandum if, let's say, initially the entity already issued a sales invoice. Okay, so if there's an additional, okay, there's an additional billing to customers or adjustment, then that is covered by a debit memorandum. Next, credit memorandum. Okay, the opposite of the debit memorandum. This is a written notice informing the client or a customer of a reduction in his account. Okay, that is credit memorandum. How about payroll? This is a written list of gross pay. This is not gross sales. Gross pay, its deductions, and the new amounts to be paid to employees. Or net pay. Actually, this is net pay. So you can see in the sample, you have here the payroll register, wherein you can see here the details of the salary of each employee. Okay, although it's not yet accomplished, the payroll register is not accomplished, but this is just a format. Okay, just to show you how it looks like. You have here the name of the employee, the basic pay, the overtime pay, the undertime or late, the gross pay, and the deductions. And deductions include the withholding tax, HTMF is for Pag-ibig, SSS, PhilHealth, and okay, you have the net pay. Net pay is actually equals gross pay minus all these deductions, withholding tax, HTMF, SSS, PhilHealth. So that's the deductions for your payroll, and if you deduct that from your gross pay, you will get the net pay. Okay. About statement of accounts, this is a report issued by a bank or creditor to a customer containing the amount or the amount billed, credits given, and the balance. Okay, and this is an example of statement of account, and usually this is common in credit card companies. Okay, they issue statement of accounts to credit card holders or their client. Let's move on to step number 2, which is analyzing accounting transactions. We have 3 procedures here. One is determine the accounting elements affected, value received, and the value parted with. We did this in our previous session. We identified what accounting elements, whether assets, liabilities, or owner's equity, were affected by the business transaction. And we even identified what value received and value parted with. Number 2, determine the effects in the accounting equation. What part of the equation will increase or decrease? We did this when we analyzed the effects of common accounting transactions in the accounting equation. Remember, we ensure that assets equal liabilities and owner's equity. Okay, if you can still remember, increase in assets could mean 3 things. It could mean decrease in another form of asset. 2, an increase in liability, or an increase in owner's equity. So these are some of the effects of the common accounting transactions to our accounting equation. And we did this number 2. Number 3, choose the appropriate account to be debited or credited using the rules of debit and credit. Remember our rules of debit and credit. Again, assets equals liabilities plus owner's equity. Assets are found on the left side of the equation. That's the debit side. That's their normal balance. How about liabilities and owner's equity? They are found on the right side of the equation. That's the credit side, and that's their normal balance. So meaning, if we are going to increase them, so we will base our side based on their normal balance. If assets normal balance is or are debit, then to increase assets, we need to debit assets. About liabilities and owner's equity, their normal balance are credit, and they're found on the right side of the equation, credit side, so we will credit them, okay? And vice versa. So if you will decrease assets, on the other hand, you will credit them. And then if you will decrease liabilities and owner's equity, you will debit them. Okay, so this is the output that we had before in our previous session. Okay, so we have 7 transactions, and then based on the transactions, we identified the accounting elements affected. This is number 1, whether assets, liabilities, and owner's equity. And then we also identified whether the effect in the accounting equation is an increase or decrease. So we'll check the amount. If it is increased, then we have it positive. The figure is positive. And then if it's a decrease, okay, the figure is negative. Okay. And then we choose the appropriate account title or account to be debited or credited using the rules of debit and credit. Although we are not yet in the debit and credit, but we were able to identify the account title, okay, for each transaction. Okay, in terms of rules of debit and credit, we will be using that in our next discussion. Okay, we are now on step number 3, recording the transactions in the journal. Okay, what is a journal? This is the chronological record of the entity's transactions. Okay, chronological meaning you have to record the transactions as it transpires. Of course, you will start with the first day of the month, the second day, the third, and up to the last day of the transaction or of the accounting period. And then each transaction is initially recorded in a journal rather than directly in the ledger. We will be discussing about posting to the ledger in our next session. Okay, journal is also called the book of original entry, and general journal is the simplest journal. And for this purpose, what we will be using is the general journal. We will record all business transactions, those which are recordable, to the general journal. And this is how we journalize transactions. I lifted the first two transactions in our previous slide. This is actually the output, our output in our previous discussion. Okay, I just lifted the first two transactions. Okay, this is the business of G Season, and she had June 1 and June 2 transactions. And our task for this morning or this session is to record this in the journal. Okay, we recorded the transactions of G and Season initially in this format wherein we have here a column for assets, liabilities, and owner's equity. Per accounting element, per asset, you have the account title and the amount. Same with your liabilities. You also have the account title and the amount. Owner's equity, the same. You also have the account title and account and the amount. Okay, so our task again is to write this, record this in the journal because this is not how we record transactions. Okay, this is the general journal, and this is how the general journal looks like. And again, we will just put these transactions in the journal. Okay, the first thing is the date. Okay, you have the date column, the particulars, the posting reference. We will just, for the meantime, leave it blank because we will be using this PR when we post this transaction to the ledger. But for the meantime, we will be focusing on the date column, particulars column, debit and credit columns. Okay, so for the date, since the transaction of GN is 2023, so you have to type or write 2023. Okay, and then since first transaction transpired last June 1, then you type or write June 1. How about particulars? Particulars is actually for account title and description. For some, instead of particulars, they write here account title and description. But for this discussion, I just used the word particulars. Okay, and then the first line of our entry should always be the debit entry. Okay, again, the first line, okay, that we should write here should be the debit entry, and then followed by the credit entry, and then followed by your description. And this is how we write the entry. Okay, so we have here cash increase 350,000, GCs on capital 350,000. When we write this in our journal, remember the rules of debit and credit. Okay, so if you can still remember, assets increase. Okay, if you will increase asset, you will debit asset, and cash is an asset, and this is an increase, so meaning you will debit it. And then for your GCs on capital, this is an owner's equity account, of course, positive 350,000. So an increase in your owner's equity means a credit entry. Okay, so we will write here cash because cash is a debit because we will increase it. How much? Okay, 350,000. And then second line will be your credit entry. You just indent slightly. Okay, okay, yan. Okay, so this is how you write the credit entry. G season capital, so slightly indented. After your debit entry, how much? The same amount. After that, include the description or the explanation of the transaction. Okay, okay, you indent a little. Okay, slightly indented. Number one is to record cash investment of G season. And then after this transaction, we usually skip, okay, one line, and then we move on to the next transaction, which is June 2. Okay, so computers, why computers? Why debit? Because this is an asset. Increase means debit. Increase in assets means debit. So we will write debit computers, and then the amount is 200,000. And then followed by accounts payable. Because remember, under rules of debit and credit, if you will increase liability, that's a credit entry. So right after your computers, you have to write or type accounts payable. Okay, how much? 200,000. And then your explanation again to record purchase of computers on credit. So this is how you record transactions in the journal. Okay, again, let's summarize. You put the year. Since this is your first page, you put the year, and then right after or below that, the month and the date of transaction. Okay, the day. Okay, this is June 1. And then under the particulars column, you have the debit entry. And then right after the debit entry, your credit entry, which is slightly indented. Then after your credit entry, you have the explanation, which is also a slightly indented, okay, to describe the transaction transpired. Then after that, you skip one line, okay, leave one space, and then you move on to the next transaction, okay? So let's say this is page number 1, and then you will accomplish page number 2. So that's the time that you will again write the year and then the month, okay? So I hope that is clear with you. So let's have an example, more example with regard to journalizing transaction. Okay, let's have an exercise. The following are transactions of JL Computer Services for the month of May 2023. Okay, May 1, Jemel Limhoco invested the following assets to JL Computer Services. Cash 100,000, 3 computers with market value of 20,000 each. So meaning how much is the total market value of computers for 3 computers? So that's 60,000. 20,000 times 3 pieces. Okay, May 2 bought supplies for cash, 4,000. May 4 bought 3 computer tables for 15,000 by issuing a promissory note to RSG Merchandising. RSG Merchandising is the supplier of computer tables. Okay, number 5, or May 5 received 15,000 cash from various customers for encoding services rendered and then May 6 sent a bill to Angel Rose for computer services rendered 20,000. So we have this 5 transactions. So how will you record it in the journal? Okay, first, we have to identify, okay, what accounting elements are affected by our transaction. Okay, so we identified that these transactions are all economic activities, and these transactions will affect our assets, our liabilities, owner's equity, income accounts, and expenses. Okay, for May 1, so we have assets of cash 100,000 and computers 60,000. These two are assets since JL Computer Services will will receive cash and computers, therefore its assets will increase. So meaning we will debit cash 100,000 and computers 60,000. So what is the credit entry? Since these two items, okay, you have cash and computers are the investment of Jemel Limhoco, then our credit entry for this is Jemel Limhoco, capital, total of 160,000. And this is how we present it. Okay, so we have May 2023. Okay, 2023, May, and then 1, we debit cash 100,000 because increase in cash means debit. Computers means positive increase, so we will debit 60,000. And then we credit Jemel Limhoco capital, slightly indented, total 160,000. Increase in capital means positive, you will credit them, okay, or you will credit it. And then the explanation is to record initial investment of J. Limhoco. Okay, this entry is called compound entry. If your entry has more than one debit entry or more than one credit entry, that's actually a compound entry. If you want, you can also present it 2 entries, okay? That's for May 1, you have cash 100,000, debit and then credit Jemel Limhoco capital 100,000, and then you have the explanation for that. Okay, skip. Then another entry for computers, debit computers 60,000, and then credit Jemel Limhoco capital 60,000, and then you explain to record initial investment of J Limhoco. So meaning it's either compound entry or simple entry. You can prepare either either the compound or the simple entry. Okay, so it's up to you. But if I were you, it's advisable that you prepare this compound entry. Okay. Okay, how about the next transaction? I already gave you the entry. Okay, next transaction is bought supplies for cash, 4,000. So you debit, this is May 2. Prepaid supplies or supplies, how much? 4,000. Why debit? Because we increase our assets. That's positive. Then credit cash because we paid in cash, 4,000. Okay, explanation to record purchase of supplies. This is an example of increase in asset and then decrease in another form of asset. Okay, this is May 2. How about May 4? May 4 is bought 3 computer tables for 15,000 by issuing a promissory note to RSG Merchandising. For May 4, okay, JL Computer Services is the issuer of promissory note for 3 computer tables. So meaning, JL Computer Services has a liability, has a payable, okay? So with that, since it has a payable, it will increase its payable. Increase in payable means a credit. So if that is a credit, meaning you will write it after the debit entry. So what is your debit entry? Your debit entry will be furniture and fixtures. That is for computer tables. Okay? And how much is 50,000? Okay? Debit, furniture and fixtures, 15,000. Okay? Credit, notes payable, slightly indented, 15,000. And you have to write the explanation, which is to record purchase of computer tables by issuing a promissory note. Again, if you are the issuer of promissory note, then you have the notes payable. However, if you are the receiver of promissory note, then you are to record notes receivable. Okay, I hope that is clear with you. Next. Okay, we still have 2 more transactions. Let's move on to the next slide for our last 2 transactions. Okay, May 5, received 15,000 cash from various customers for encoding services rendered. Actually, this is a revenue, okay, activity. May 6, sent a bill to Angel Rose for computer services rendered, 20,000. This is also a revenue activity or transaction. May 5, May 6, these are both revenue transactions. And how are you going to record this? Okay, since computer services is a non-prof service, then we use service revenue account for our owner's equity. Okay, income account. Okay, income account. And again, if our income will increase, that means increase also in our owner's equity. Increase in owner's equity means a credit entry. So that's why we have a credit of service revenue. So how about the debit? Okay, May 5, received 15,000 cash. Okay, so that's the value received. The cash of the JL Computer Services increase. So meaning you have to debit, okay? Debit cash, 15,000. Then credit service revenue, 15,000. Explanation to record cash received for services rendered to various customers. Okay, and then skip another line, okay? One line or one space. Okay, that is May 6. Last transaction, sent a bill to Angel Rose for computer services rendered, 20,000. This is a revenue transaction. However, for May 6, JL Computer Services was not able to collect cash from Angel, but instead, the business sent a billing to Angel Rose. Okay, so what will be our entry for that? Okay, so May 6, so we identify that is a revenue transaction and we use account title service revenue. How much? 20,000. Why credit? Because service revenue is an income account and it will increase our owner's equity. Okay, increase in owner's equity meaning we will credit the account. Okay, how about your debit? Okay, so since we did not yet collect the services rendered, okay, the amount of 20,000 from Angel Rose, we just sent a billing. So that's our accounts receivable. And remember in our discussion regarding chart of accounts receivable is an asset, okay? And this is a debit entry, increase in assets in the form of accounts receivable. Okay, debit accounts receivable, 20,000, credit service revenue, 20,000, and then slightly indented to record billing to Angel Rose for computer services rendered. Okay, so I hope you learned something from our discussion. So this is how you record in the journal. Okay, so at this point, thank you very much, and I shall see you next video lecture for our next topic, which is about posting to the ledger. Okay, by the way, these are my references, and do not forget to subscribe to my YouTube channel. Thank you.